The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Very warm welcome to this Tuesday edition of Squawk Europe with Karen Cho, Juliana Tattlebaum and myself, Steve Sedgwick, and these are your headlines. The US Senate passes a bill that could end the longest ever US government shutdown within days and restore the federal funds until the end of January.
Expectations of the government reopening fuels gains in stocks. The Nasdaq seeing its best trading session since May.
And potential tariff relief for Switzerland as President Trump indicates the White House is looking to lower levies. A report suggesting the level could be cut from 39% to 15%.
I haven't set any number, but we're going to be working on something to help Switzerland along. We hit Switzerland very hard. We want Switzerland to remain successful. And, you know, we're a part of Switzerland in the sense that they've been a very good ally. We're working on them and some others.
Riding the AI wave, Softbank books a $19 billion gain at its vision fund driven by its investment in OpenAI.
So, good morning. Someone once said to me that the self-confessed financial guru is the man who bought a house in 1988, held onto it, and basically calls himself a financial guru. In the same vein, which I almost bought a house in. In the same vein, my comment to you, Juliana, yesterday when you were on other things, Karen, is when I said, well, it's a buy the dip day, isn't it, kind of thing? Because obviously, every time we've had a dip, buying the dip so far in 2025 has been the strategy which is why retail has won. It wasn't the most unobvious thing I've ever said.
That's the Nvidia trade, isn't it? Buy the Nvidia stock trade when it comes off the highs. And you saw really a regrouping of Nvidia yesterday. To me, what's been fascinating is just how much gold is still off its highs. And that's been one of the other favored trades. You've seen a lot of areas of the market try to recapture territory that's been lost. Gold is a long way off some of the highs that it inked recently. I think that is fascinating given the stampede in there and just typically what it's meant to do, shield you in downtime. So it hasn't necessarily been the safe harbor. And we'd had a discussion weeks back saying what is the potential if we do see a market sell-off? Will gold be that safe harbor you hope it will be? So I think that's been fascinating. But the other hot areas of the market, you've certainly seen investors go back into some of those again.
I think part of what was interesting about yesterday's trade was that we saw the tech rally extend yesterday, more gains, especially for the Nasdaq, at the same time that investors dialed back their Fed cut expectations. And it seems to be linked to the fact that now that the government shutdown looks like it's going to end, it makes it more likely that the Fed could pause their rate cuts. So investors dialed back the likelihood of a December cut to 63% by the close. It had peaked as high as 74% last week. And despite that, markets charged higher.
Yeah, and as we also mentioned on the show, the asymmetry in the market is extraordinary. A market that never, ever sold off on a shutdown fear. At no stage could anyone really justify any downticks on the back of the shutdown. Rallies hard when we don't have a shutdown or we see the prospect of an end of it. It is unbelievable asymmetry, but we've learned to live with that, haven't we? Because the US Senate has officially approved a deal to end the longest US government shutdown in history, securing funding through to, well, it's only the end of January. I mean, gosh, talk about short-term financing. 8 Democrats, controversially, certainly in their own party, crossed the aisle to support the measure, drawing rebuke from colleagues given a lack of assurances on healthcare subsidies. Yeah, there's a vote, but no more than that. The bill will now head to the Republican-held House of Representatives, where it could pass as soon as Wednesday, according to the House Speaker, Mike Johnson, before making its way to President Donald Trump's desk to be signed into law. Speaking ahead of the official Senate vote yesterday, President Trump backed the proposal.
Well, it depends what deal we're talking about, but if it's a deal I heard about, that's certainly, they want to change the deal a little bit, but I would say so. I think based on everything I'm hearing, they haven't changed anything, and we have support from enough Democrats, and we're going to be opening up our country. It's too bad it was closed, but we'll be opening up our country very quickly.
Here's a check for you on how Wall Street shaped up yesterday. As we were just discussing at the top of the show, more gains across the board led by the tech-heavy Nasdaq. That index gained about 2.3%. The S&P 500 gained about 1.5%. It was the best day in 4 weeks for the S&P. And when you break it down by sector, 8 out of 11 sectors in the S&P were positive in the session, led by technology. Shares in the tech sector rose 2.7% overall. A few of the big movers, the focus names yesterday, Palantir, Nvidia, Tesla, more very strong gains there. Everyone in the retail space seems to continue to love the Palantir story. That stock up almost 9% in the session. You've also got Nvidia gaining almost 6%, Advanced Micro about 5%, and Tesla gaining strongly as well. So very robust tech rally stateside yesterday. In terms of the Asian trade overnight, here's the picture. You've got a bit of a pullback there, nothing major, but a little bit of a pullback. The Nikkei 225 down about 14 basis points. The Hang Seng in Hong Kong also slightly lower. Shanghai Composite coming off a little bit, while the Kospi over in South Korea gaining a further 0.8% after yesterday's very strong gains. The Kospi gained about 3% in the previous session. In terms of European markets, here's your early look at European futures. We're looking at modest gains across the board here in Europe. The CAC 40 looking to gain about 0.4%. The Xetra DAX, the FTSE MIB and the FTSE 100 all looking to gain further ground as well. And this adds to yesterday's rally where we saw the stock 600 gain about 1.4%, more than 1% higher in every Borsa. So it was a really broad-based move higher in Europe. And finally, in terms of U.S. futures, here's what Wall Street is indicating right now. Fairly muted start to trade indicated stateside. So investors perhaps taking a breather after the mammoth rally that we saw yesterday.
To me, it gets interesting around the politics, and I'd be interested in hearing your thoughts, Juliana, being an American and knowing the ins and outs of what we just saw in recent weeks. But the fact that we saw signs of life for the Democrats in some of the most recent elections, from New Jersey to Virginia and New York City, there was some appetite there to get back into the Democrat trade. And I think that's fascinating because after what has been a clean slate for Trump, he's cleaned up everywhere, and the anointing not just of Trump and the Republican Party, but more broad-based across the states, I think has been something that we've been really facing on a policy front for many, many months now. So to see that flipped on its head in some of these various different regions, I think is fascinating and might have ramifications coming through into 2026 and what that means in terms of some of the pushback. And Steve just mentioned in that top read that we only have a short-term extension here when it comes to the nation's finances. Democrats are going to go for this, aren't they? And if you look at the split between who's been blamed for the shutdown, Republicans mostly to blame, according to Americans, 50%. Democrats are there with 43%. It feels like we're going to see a lot more politics in 2026.
You raise a really interesting point around the shifting politics in the U.S. or the potential shift here. And I think one of the most compelling takeaways from the Democrats' victories over the last couple of weeks has been the focus on cost of living. And that's really what they focused on. That's what ultimately got them over the line. And it's a stark contrast to where the Democrats have gone in recent elections. And I think it speaks to the growing dissatisfaction among American voters with President Trump's economic policies. Their polls suggest that voters are becoming disenchanted with tariffs. And I think you have to look no further than President Trump's Hail Mary. That's what some were calling it over the weekend when he said, hey, don't worry, we're going to be issuing $2,000 dividends coming from these tariff revenues to everyone, except the high-income Americans. But everyone else is going to get a $2,000 dividend check. Just say, I think, an indication of his awareness of how the tariffs are being received right now.
I think this is brilliant analysis, but it's nothing to do with what happened yesterday. This is the touch paper. Sure, was okay. We found some good news, but can we do that board again, Roger? Have you got the board? There we go. Thank you. As if we hadn't planned it. Look at that. Palantir going up 9% is nothing to do with the shutdown. Nvidia going up 6% is nothing to do with the shutdown. Advanced Micro is nothing to do with the shutdown, and Tesla certainly isn't. This is purely about momentum and risk on and the trade that has worked every single time this year. Now, is it safe buying Palantir at 195 times forward? Is it safe buying Tesla at 200 odd times forward? Is it safe buying MicroStrategy when we're talking about Bitcoin treasury strategies as well? Nvidia, I think I would put it in front of in a different bracket, because actually, even though it is the poster child of publicly listed companies, the fact of the matter is, its market cap is not divorced from reality. You could justify a 29 times forward, which is ironic, seeing as the company at the epicenter of the entire public sector, and I say public sector rather than private sector, boom we're seeing this year, is actually trading on a valuation which you can kind of justify.
So when you say they're not connected, can I push back on that? Because to me, they are connected in a way. You've had these two twin drivers. One of them has not been driving, has not been going in the right direction. That has been the broader US economy because of some of the undercurrents around tariffs, some of the uncertainty around shutdowns. So what has been really driving this rally has been the super investment in AI that has been a huge prop for the US economy this year. Massive investment worth trillions of dollars. If you took that away, then you've got to ask where the US economy would be at, what type of state it would be in thanks to all the tariff uncertainty at this stage. And I think what you're seeing yesterday, again, there's been a ton of fears. And if we get a US economy that settles down thanks to some of these lurking fears around tariffs and shutdowns, does it supersize the AI rally again? I'm not saying that's healthy. It could be another driver to push us over the edge in terms of some of the excess, but they are interconnected.
Of course. Of course, the market reacts on the news it has of the day, and so hence that is the touch paper, the catalyst for what happens thereafter, the exponential move we see thereafter. But the future of the success of AI hyperscaler spending at the moment and the vast amount of debt that's being raised and the stunning valuations that are there is absolutely nothing to do with whether the US government heads in shutdown or not. Because, and we've kind of almost seen the evidence for 41 days, haven't we? Where for 41 days, any downtick in the equity market, and there were a couple, obviously the most notable being last week, was not about the shutdown. Nobody ever, in fact, every single man and woman who came on this set, or we spoke to down the line, has said to us, shutdown not touching the side. Shutdown not touching the side. It's not really affecting the broader economy. It's not affecting this. It's not affecting that. So we have to take them at the word. They are the experts we interview as well.
But it hadn't been until Juliana's point where it could. And I think that's the problem. We're getting to this stage. We need to get some of that evidence around the jobs market to make a decision on the next Federal Reserve move. Interest rates all important for sustaining some of this rally.
Jobs market plus inflation plus FOMC plus Trump world, which are the four kind of things that we talk about on a very, does not equal 220 times forward Tesla, does not equal 190 times forward. We never extrapolate all the things that are going on in those four, which are our, probably our most important stateside things we look at, as having a direct effect on whether we buy Tesla on the fact of it, on the fact that it might have robots in 20 years.
I think that when it comes to a lot of these retail favorite stocks, you have to remember that that's exactly what they are. They're retail favorites. And when you hear President Trump talk about something like a $2,000 dividend check, or you hear more and more rhetoric around returns coming to Americans in the beginning of next year and further rate cuts from the Fed, all of that is boosting to, is enhancing to sentiment. But I think to Karen's point, we're about to get a raft of data that we have not had for the last 41 days, and that could significantly change the picture here. So I think now...
Sorry, I'm going to push back at you, because she's been pushed back at me, and it's like a domino going this way. Really? You honestly think, and I know what you're trying to do, do you really believe you're going to get clarity on the US jobs market from a raft of data that's coming out now? I think we're going to get the same fog.
I think we've got the labor market data and we've got the inflation data. And what will be interesting is the interplay between the two and whether we start to see a more sizable tariff impact here in terms of inflation, because clearly there has been some evidence of rising goods prices in the US, and we haven't had the extent of the data that we are used to getting. So I think the interplay between inflation and the labor market is going to be interesting.
I think that is stunningly optimistic that you think we're going to get clarity.
It's the nuance, though, isn't it? The market had the perception that you've got a Fed that is going to be throwing fuel onto the fire, effectively cutting into this cycle. But now we've transitioned to, oh, hey, we're sitting in the middle of fog, we're not doing anything. So it's inaction from the Fed. So if we get any clarity from the central bank's position, I think that is what fuels the market from here. And don't forget, Santa Claus is just around the corner, as we know, in terms of the seasonalities.
I think one thing just to add, Karen, you raised this point last week, and I think you may have even picked up on it as well this morning, Steve, that when it comes to the AI spend, part of the reason that the market has been so comfortable with it is because these tech giants are sitting on huge hoards of cash. But as the investment becomes more funded by debt, that's when investors could become concerned. I think there's an increasing amount of focus now on companies like Oracle, which are don't have the cash to fund these major investments, and they're turning to debt markets, and that could begin to change the tides here.
And the FT's picked up on that story today about the movement in the pricing of some of those yields. And let's push on. Coming up on the show, the US Senate officially passes a bill to end the longest US government shutdown in history. We'll discuss what happens next. Plus, Softbank posts an almost 200% jump in first half net profit as Q2 numbers blow past expectations. We'll break down the wider impact for the AI trade. And CNBC is live from Web Summit in Lisbon, where Arjun is speaking to a host of key technology leaders. First up, the CEO of Aura at 8:30 London time.
Executive Decisions is the new podcast from CNBC, where I ask powerful leaders about their decisions that changed everything. I'm Steve Sedgwick. Here's the CEO of the London Stock Exchange Group, Julia Hoggett.
There is no justification whatsoever for not doing the right thing, even if the right thing is hard to do. Which also means that if the context changes or the information changes, it is absolutely fine to also change your mind.
That's Executive Decisions with me, Steve Sedgwick. Get it wherever you're listening to this. UK wage growth slowed to 4.6% in the 3 months to September compared with a year earlier, matching forecasts. The unemployment rate rose 20 basis points compared to the previous 3 months to 5%. Look, one of the great voices on the jobs market in Great Britain, and in fact has a great view on the broader market, is James Reed, who is chairman and CEO of Reed. Lovely to see you, sir. Thank you very much indeed. Obviously, you are the author also of Karma Capitalism.
Thank you.
Why being a good business is good business. So we'll come to the book a little bit later on. Roger's jumped the gun. He's already there showing you the book. And, available at all good bookstores, I'm sure. Are you doing the Audible book?
I'm in the process of recording that, yeah.
Is it going to be Stephen Fry-like? I hope it's as good as Stephen Fry.
Well, my wife was quite mean. She said, nice work for someone who likes the sound of his own voice. So
Very good.
I'm in the middle of it.
I'm sure that's not my wife talking about me. Anyway, moving on. In terms of the labour market moment, you actually came up with a very interesting concept last time we spoke to you. We're talking about the jobs drought in the United Kingdom caused by all kinds of things, and concern about AI, but immigration as well, and misguided policy as well. Just in terms of the latest data you're seeing in the United Kingdom and elsewhere, are you getting more concerned, similar to what you were before, or actually things are getting slightly better? I can't imagine it's the latter.
Well, I've just been studying the latest statistics from the Office
Which is
of
nice
National
because we can do that in the United Kingdom, unlike our dear friends in America.
Yeah, they've just come out 7 o'clock this morning, so this is hot off the press, so to speak. So the concern is unemployment has continued to go up, now at 5%, which is a high post-pandemic, and that's a direction of travel that we were expecting. But there is a sort of chink that I saw in the data that encouraged me in that the number of vacancies has stopped falling. You might remember I was concerned that we'd had 39 consecutive periods of declining job vacancies. They actually rose by 0.2% in this period. So that's the first increase in nearly 3.5 years, even though it's very, very small. So does that mean we've hit rock bottom? I hope so. It might not, but it might be that vacancies are now stabilising and employers are coming back into the market.
This is the beauty of the show. I didn't expect you to say that.
So I mean, I'm an optimist by nature. I should caveat that. And I was looking for, is there anything here? But I have been tracking that number for a very long time, and I've always said, when I was concerned about it, at least it stopped going down.
Great.
What do we read into that? If this is actually the bottom when it comes to vacancies?
Well, I think it means that unemployment will continue to rise because of the fallout of previous concerns, but it's not going to hopefully get a lot worse. But I don't know. I mean, the trouble is this sort of levelling off occurred in the late summer, early autumn, when business is usually pretty good. There's lots of summer-related business, and people are starting to ramp up for Christmas. That's a busy time of year. Whether it gets a chill again as we go into sort of November, December, I'm less clear. So, watching that very carefully.
What are you seeing in terms of white-collar jobs specifically? I think everybody's trying to understand just how disruptive AI is proving to be with regards to white-collar jobs.
I think it's proving to be very disruptive, and I think it's only just beginning. So we've looked at surveying our clients, and 15% said they were cutting back on hiring because of the introduction of automation and AI. So that was very clear, that a direct response to a direct question. And we've seen the number of graduate roles collapse on our website from 180,000 just after the pandemic to around 50,000 this year. So that's a very dramatic drop. So AI is just beginning to work its way through, and it does seem to be affecting white-collar jobs. Our latest statistics show that accountancy jobs have fallen over the year more than most areas.
Before Karen asks you some very pertinent questions, just give an anecdote. I don't know if I was doing my tax return. Have you done your tax return, everybody?
No, you're a little bit early on.
I'm a little bit early.
No,
The reason I'm interested because
by
you've just
this.
pricked my interest, and I wonder actually what you and the viewers think about it, because I had a very minor issue that I wanted to sort out regarding pensions. I'm mostly PAY, so it's so easy to do. Classic, yeah. But I rang up an accountant and said, how much would it be to do this? And they quoted a very high figure, I thought, for the work that was involved. I stuck it into AI. AI came back with a whole host of answers. I checked it with the HMRC, what AI had told me, and thought, yeah, that makes total sense. I didn't use that accountant. Isn't that
I
extraordinary?
think they got stuck on your bonus.
Yeah.
It was very difficult.
You'll remind me what a bonus is again. I can't find that word. But my point being is if I and thousands, maybe millions of others go down the same route, those accountants are toast.
Yes, and I mean, and accountancy firms will be doing that themselves as well, so that they're processing.
And yet they were
things
still
much
trying
more
to charge me the same amount.
Well, probably.
Can I bring up a point? Something that I'm looking at in the data and makes me wonder, is there a problem looming with youth employment, or youth unemployment as we typically call it? Because the reality is the behaviour from employers so far is to hold off on some of the graduates. You've just mentioned in your own numbers. We've seen it in some of the others as well. And in fact, in the ONS numbers previously, the increase we saw in the unemployment rate was actually driven by younger people. So if we're talking about these positions at entry level that AI can do, it suggests that bridge from the education system to the workforce may be starting to crumble. So it does beg the question, could AI be causing a youth unemployment problem?
Yeah, I think that's spot on, unfortunately. I mean, we're seeing that in the data in the UK with youth unemployment rising. Nearly 1 million now NEET, as they call it, not in employment, education or training. And this hasn't been seen for many, many years at that sort of level. And actually, the size of the young cohort isn't that big, so 1 million proportionately is very large. And we're seeing that a lot of entry-level jobs are just disappearing. So it is much more difficult for young people to progress into work now. So if someone's telling you they're finding it hard, believe them, because it really is.
Well, the other anomaly here that we may see in the labour market then as a result of this is the case, and it continues, is that wages actually go up, because the other data we've been crunching is that when you have fewer graduate positions, it means you end up with a slightly older, more skilled workforce on higher wages. So therefore, even though we're talking about all the pressures economically that are coming to bear, you typically think there may be some sort of a ceiling for increasing those wages. If we're taking out the lower end cohort with the lower wages, doesn't that again skew the numbers where we see wages, at least for a short period of time, increase from here?
Yeah, fewer people earning more per head. Yes, that's what we are seeing, in fact. I mean, you're seeing that with the statistics of 4-5% increases in wages. Some of our own data shows 7% increases year on year. So we are seeing that. And a lot of the entry-level jobs have been hollowed out, and a lot of part-time jobs have been removed. And that's partly to do with tax decisions in the previous budget, when they started to tax lower-paid workers through national insurance. So it's harder for people to get entry-level jobs. And that should concern everybody, because the next generation won't get going and society will become more divided.
Yeah, which is we're seeing across the globe as it is. Tell us about the book. Roger's got a I think he's already put it up, but there it is, Roger. You're very quick. Karma Capitalism, why being a good business is good business as well. Philco, noun, a philanthropic company or philanthropy company with at least 10% of its shares owned by a charitable foundation. You go into all different areas.
Yeah.
There are some people out there who say, I'll come from the other side. Oh, this is all woke. Stakeholder
That's
stuff.
definitely not woke. So I want to start by saying this is a small orange book that contains a big idea.
Oh, very good.
So that's really important to
You've
stress.
worked on that catchphrase, James.
No. I've worked on the book, and I wanted to make it a short book so it was easy for business people to read.
Easy for business journalists.
Well, anybody who's interested in business, because we're all busy, and I wanted it to be accessible. But Karma Capitalism is a philosophy, and the Philco, or philanthropic company, is the vehicle that delivers it. And a Philco, very simply, is a company, as you described, that has at least 10% of its shares owned by a charitable foundation. Now, this is serious business advantage because we have researched this. Our company, Reed, is one, but there are lots of other fantastic brands that are featured in the book. I'm talking about companies like IKEA, Lego, Maersk, Carlsberg, Novo Nordisk, very successful companies, Patagonia, that are Philcos. So this isn't woke capitalism. This is karma capitalism.
I love it.
And it helps companies compete. So the actual data shows these companies last longer and make more money than regular businesses. So what's not to like about that?
I love this line, what is the point of business? That's a good question as you start them wanting for CEOs.
I think we ponder it on a daily basis. What we should say is,
do something purposeful.
What is the point of some businesses, I ask sometimes, certainly some of these unicorns. James, I know we're going to try and do something a little bit more long play coming up soon. So,
yeah, well, thank you for that.
Yeah, well, that's very exciting, and I can tell you a little bit more about it now. James Reed, by the way, Chairman and CEO of Reed. Thank you, sir. Well, this is what I was talking about. I have some very exciting news, well, for me at least, and CNBC. We're launching a brand new original podcast. It's called Executive Decisions with me, Steve Sedgwick, and in it, we endeavour to tell previously unheard stories about what makes a leader. And I think a lot of you really want to know that. These are the rock stars of the corporate world, what key decisions they've made to get where they are today and what they got really badly wrong. I think that's really important. Big leaders have all made big mistakes. And what their best moves were as well. It's been a real passion project for me and my team, and I want to shout out to Tom, to Brittany, to Leonie, and Tessa, and Christy, and everyone. We've worked so hard on this one as well to put it together, and just give you a little sneak preview of one of our first episodes with the magnificent Dame Julia Hoggett, who is the CEO, of course, of the London Stock Exchange.
There is no justification whatsoever for not doing the right thing, even if the right thing is hard to do. I want to be proud of every decision I've made, not just tomorrow, but in 20, 30 years' time. And therefore, if that becomes the basis on why you make a decision, you've given yourself permission to take the long view. And even some things which in the short time are not popular or look difficult or have people throwing brickbats at them, if you feel it's the right decision, it's the right thing to do. And if that's the logic, it becomes easier.
And I think that tallies with what James just said, if it's the right thing to do. And one thing I found out about a lot of the CEOs I've been speaking to as well is they don't just go in and do their day job. They all, to a man and to a woman, have used their platform to do other things because they own a magnificently privileged position as well. And I've been stunningly impressed with the human side of these incredibly hardworking and successful people. And you can listen to the first 3 episodes of the podcast in all the usual places. There it is. You can watch it on YouTube and on CNBC.com. I like the watching bit personally because I can't just listen to myself. Anyway, that's from today, and we've got the first 3 episodes have hit all those usual places. Miss Jo Malone CBE is airing this Saturday right here on CNBC.